Today we're digging into a really fascinating story. It's about a company whose products, well, they're probably sitting in your kitchen right now. But here's the thing, their stock has been giving investors a massive headache. Yep, we're talking about General Mills. So what is the connection? What do Cheerios, Haagen-Dazs, and a stock that's, well, sinking have in common? The answer, of course, is General Mills, stock ticker GIS. And this question, it really gets right to the core of the puzzle we're going to unpack in this explainer. I mean, look at this. On one hand, you've got this absolute empire of brands we all know and love. I mean, they're staples in our homes, right? But on the other hand, you've got the cold, hard reality of its stock. And let's be honest, it's been pretty weak. It's this wild contrast between a great company and a stock that's just struggling. But then there's this number. 4.85%. Wow, that is the annual dividend yield. Now, if you're an investor focused on income, a number like that, it just makes you stop in your tracks and go, okay, hold on a second, maybe there's something here after all. It's that little bit of sweetness in a really complicated story. Okay, so let's really get into it. Let's unpack this whole paradox. And to figure out what's really going on with General Mills, we're going to look at it through a really simple lens, a simple framework. Is the company big? Is the business good? And maybe most importantly for anyone thinking about investing, is the stock actually cheap? I love this quote from the source material. It just nails the whole situation perfectly. Its stock has been as cold as its frozen pizza, but its dividend is as tempting as a scoop of Haagen-Dazs. I mean, come on, that's perfect, right? It perfectly sums up the puzzle. So let's figure this out. All right, first things first. Part one of our framework. Is General Mills big? And the answer is, oh yeah, it's a resounding yes. We are talking about an absolute giant in the consumer goods world. And look, this company isn't some startup that just appeared. I mean, its roots go all the way back to 1856 as a flour mill. We're talking over 160 years of history here. And over all that time, it's just kept evolving, snapping up iconic brands like Pillsbury and Haagen-Dazs and becoming the global food powerhouse it is today. That kind of longevity, that's a huge part of the story. And all that history, it's built this. A true brand empire. I mean, these aren't just names on a box. For millions and millions of people, they are breakfast. They are baking. They're even what you feed your pets. With a market cap hovering around $27 billion, its size, its reach, it's just undeniable. So check. That's the big. Okay, so it's big. We've got that. But, being big isn't everything. Is it a good business? That's the next question. So now we've got to look past the cereal boxes and get into the financial engine to see if the numbers really hold up. Now, before we jump into the spreadsheets, you have to understand this one really crucial idea, the brand moat. Seriously, this is like General Mills' superpower. All that loyalty and recognition for brands like Cheerios, it creates this massive competitive advantage. It gives them pricing power, and it makes it incredibly hard for some new company to just show up and try to steal their customers. It's a powerful thing. And here you go. Here's the proof of that brand moat in the numbers. The gross margin, nearly 35%. That's pretty strong. But look at this. The real star of the show is the return on equity, or ROE, 24.6%. Now, what that number tells you is how much profit the company squeezes out of its shareholders' money. And that is way, way higher than its competitors. This is what a good business looks like on paper. Okay, so we've established it's big, and the numbers say it's good. So that brings us to the million-dollar question, right? The most compelling question for any investor. Is it cheap? Let's take a look at the valuation right now. And this is where things get really interesting. Just look at this snapshot. The current stock price is literally bumping along the bottom, right near its 52-week low. Meanwhile, the average analyst target, well, they think there's a potential upside of around 18%. Now, for a stable blue-chip company like this, that is a very, very interesting gap. And hey, let's not forget the hero of our story from the beginning, that juicy 4.85% dividend. This is so important. It basically means that even if the stock price goes nowhere for a while, you, as an investor, are still getting paid a really nice income stream just for owning it. Think of it like a cushion, a cash buffer while you wait for the rest of the market to maybe, just maybe, see the value that you see.
All right, I know what you're thinking. You're asking the exact right question. If this company is so big and so good, then why on earth is it so cheap? And you're right to ask, because there is always a catch. So let's talk about the risks. Let's talk about the timing dilemma that investors are wrestling with right now.
So there are really three big headwinds that are weighing this stock down. First up, you've got these big picture macroeconomic pressures. Inflation, maybe weaker consumer spending. That could hurt sales. Second, competition. To keep their spot at the top, General Mills might have to cut prices, and that can really squeeze their profit margins. And third, the market is basically expecting a drop in future earnings. They're already pricing it in. These are the dark clouds hanging over the stock. And all of this creates this classic investor's dilemma. You've got two camps. The value investor looks at all this and says, hey, the company's fundamentally strong and the stock is on sale. Time to start buying the dip. But then you have the investor who's focused on technicals, on the chart. They look at that weak price trend and say, whoa, no way. I am waiting on the sidelines until I see a clear sign that this thing has turned around. And honestly, there's no single right answer here. It's a total clash of investment philosophies. So, where does that leave us? Let's pull it all together. The whole case for General Mills. It really is the perfect summary of this classic investor's dilemma. And it all comes right back to our big, good, cheap framework. So here's the argument in a nutshell. It's big. We're talking a 160-plus year history with an absolute empire of iconic brands. It's good. It's a financially efficient machine with profitability that leaves the rest of the industry in the dust. And right now, it looks cheap. The stock price is sitting near its lows, and it's paying out that awesome 4.85% dividend. And that leaves every single person looking at this stock with one final crucial question. When you look at GIS right now, are you looking at a falling knife that's just going to keep on dropping? Or are you looking at a coiled spring, just wound up and ready to pop the second that market sentiment finally turns positive? And that is the multi-billion-dollar question.